Everybody, welcome to this meeting of the MPC, and I would like to, on this auspicious day, allow me to, on behalf of the South African Reserve Bank and all our staff, take this opportunity to join tens of millions of people around the world, around the country, in wishing former President Nelson Mandela a very happy 95th birthday. He's truly one of a kind, and we all wish him well. The period since the previous meeting of the MPC has been dominated by the reaction of the global financial markets to statements by the US Fed that a slowdown in quantitative easing may begin sooner than previously anticipated. The news impacted on capital flows to emerging markets, with outflows from bond markets in particular, but yields on long-term bonds of advanced economies were also affected. While some of the initial fears have been addressed by further guidance from the Fed, this episode gives some insight into the difficulties that could be faced in fine-tuning exit strategies from highly accommodative monetary policies, particularly at a time when global growth remains weak. These events had a significant impact on the exchange rate of the rand, creating further upside risks to the inflation outlook at a time when the domestic economy has shown increased signs of vulnerability. There has consequently been no let-up in the policy dilemma faced by monetary policy, that of a widening output gap in a worsening inflation environment. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, surprised on the downside at 5.6% in May 2013, having measured 5.9% for the previous 3 consecutive months. However, this decline is likely to have been temporary, as it was due in part to a 73 cents per litre decrease in the petrol price in May, which has since been reversed by an 84 cent per litre increase in July. Food price inflation increased further from 6.3% in April to 6.7% and accounted for 1 percentage point of CPI inflation. The other main contributors to the inflation outcome were housing and utilities and miscellaneous goods and services, which contributed 1.4 and 1.1 percentage points respectively. Administered price inflation declined to 6.3% from 8.9% in April due to the petrol price decline. Excluding petrol, administered price inflation was unchanged at 7.8%. Core inflation, which excludes food, petrol and electricity, measured 5.3%, marginally up from 5.2% in April. The headline producer price inflation for final manufactured goods measured 4.9% in May, compared with 5.4% in April. Despite the lowest starting point, the inflation forecast of the bank has deteriorated since the previous meeting of the MPC. Inflation is now expected to average 0.1 and 0.3 percentage points higher in 2013 and 2014 at 5.9% and 5.5% respectively, while the forecast for 2015 has been raised from 5% to 5.2%. A temporary breach of the upper end of the target range is still expected in the third quarter of 2013, but at a higher average level of 6.3%, it was 6.1%, followed by a return to within the target range by the final quarter of the year. The deterioration is mainly due to continued currency weakness and higher than expected petrol price increases. The forecast for core inflation for 2013 is unchanged at an average of 5.3%, and is now expected to peak at 5.5% in the fourth quarter. This measure is then expected to moderate and to average 5.2% and 5% in the coming 2 years, compared with the previous forecasts of 5% and 4.6% respectively. This upward drift in the forecast in the absence of obvious excess demand pressures suggests that there may be emerging underlying pressures, possibly due to the lagged effects of the depreciation of the rand exchange rate. Inflation expectations appear to have remained anchored around the upper end of the inflation target range. According to the survey conducted by the Bureau of Economic Research at Stellenbosch University during the second quarter of 2013, inflation expectations of all the categories of respondents remained almost unchanged compared with those of the previous quarter. Overall, the survey found that inflation is expected to average 6% in 2013 and 6.1% in the next 2 years, with financial analysts' expectations below those of the business executives and the trade union officials over the whole forecast period and within the target range. The former category is consistent with the Reuters survey, which reflects expectations of an average of 5.9% in 2013 and moderating to 5.6% and 5.4% in the following 2 years, respectively. The global economic growth outlook has remained fragile due to the continuing and deeper recession in the Eurozone and a slowdown in a number of systemically important emerging market economies. Several forecasters, including the IMF, have downgraded Eurozone growth forecasts against the backdrop of a slowdown in Germany and continued risks emanating from Portugal, Italy and Spain. In its recent World Economic Outlook update, the IMF reduced its 2013 forecast for Eurozone growth by 0.2 percentage points to minus 0.6%, with a weaker recovery than previously forecast in 2014. Although the US economic recovery appears to be gaining some traction, headwinds from the fiscal contraction remain, and the first quarter economic growth at an annualized rate of 1.8% was weaker than the initial estimate of 2.5%. The sustainability of the recovery is also at risk from rising long-term bond and mortgage interest rates in response to expectations of a tapering off of asset purchases by the Fed. There are tentative signs of stronger growth in Japan, but the sustainability of the recovery remains uncertain. The slowing growth in various emerging market economies, including China, Brazil and Russia, illustrate the difficulties of decoupling from the advanced economies, with the IMF revising its forecast for 2013 for China from 7.8% to 7.5%, Russia from 3.4% to 2.5%, and Brazil from 3% to 2.5%. The deteriorating outlook for emerging markets has been compounded by the recent capital flow reversals that impacted adversely on domestic bond and currency markets in particular. While financial markets have stabilized somewhat, the risks posed to emerging economies in general, including South Africa, by normalization of monetary policy in the US in the future are evident. The combination of slower growth in China and the stronger US dollar has also impacted negatively on commodity prices, although oil prices have been underpinned by risks related to the recent events in Egypt. Global inflation remains benign and monetary policy is expected to remain accommodative in the advanced economies for some time, as indicated in the forward guidance provided by the ECB, the Bank of England and the Fed, notwithstanding a possible slower pace of quantitative easing by the US. By contrast, a general tightening bias is evident in a number of emerging markets in response to recent capital flow and exchange rate developments. Movements in the exchange rate of the rand continue to pose the main upside risk to the inflation outlook. Since the previous meeting of the MPC, exchange rate volatility has increased, and the rand generally traded in a range between 9 Rand 60 and 10 Rand 36 against the US dollar. Since the beginning of the year, the rand has depreciated by 14.2% against the US dollar and by 11.1% on a trade-weighted basis. Much of the recent volatility and weakness has been in line with the reaction of a number of other emerging market currencies to fears of US monetary policy tightening. The rand has also been negatively impacted by lower commodity prices. Domestic bond yields increased significantly in response to capital outflows and higher bond yields in the advanced economies. The yield on the 10-year government bond, for example, increased by more than 100 basis points since the financial market turbulence in late May. Net sales of domestic government bonds by non-residents amounted to 17.4 billion rand in May and June. In July, non-residents became net buyers again with net purchases of 3 billion rand, bringing the year-to-date net total to 5.2 billion rand. Having been net sellers of South African equities in both 2011 and 2012, non-residents have returned to the market with year-to-date net purchases of 23.3 billion of equities. Despite a 15.5% nominal effective depreciation of the rand exchange rate since January 2012, the pass-through to inflation has been relatively muted, particularly when compared with previous episodes of currency weakness. This is probably a reflection of the weak pricing power in some sectors of the economy in a low-growth environment. Nevertheless, the risk remains that these pricing pressures may intensify at some stage, particularly if the exchange rate depreciates further from current levels. Market expectations are for a moderate appreciation of the rand in the coming months, although these expectations have been tempered in recent surveys. According to the Reuters Econometer survey conducted in June, Analysts on average expect a rand-dollar exchange rate of 9 Rand 70 to the end of 2013, at the end of 2013, and 9 Rand 40 at the end of 2014. There is, however, a wide dispersion between the forecasters, reflecting a high degree of uncertainty. Despite a slight narrowing of the current account deficit in the first quarter of 2013 to 5.8% of GDP, the depreciated currency reflects this deficit against a backdrop of declining terms of trade and more uncertain global capital flows. The outlook for domestic economic growth has weakened further, following the first quarter annualized growth rate of 0.9%. While more favorable outcomes can be expected in the subsequent quarters of this year, overall annual growth is likely to be lower than the 2.5% growth rate recorded in 2012. The bank's growth forecast for 2013 has again been revised down from 2.4% to 2% and from 3.5% to 3.3% for 2014. Growth is expected to accelerate to 3.6% in 2015 compared with 3.8% previously. The risks to the outlook are still assessed to be on the downside, particularly in the face of further delays in overcoming electricity supply constraints. In line with these subdued growth prospects, the RMB-BR Business Confidence Index declined from 52 in the first quarter of 2013 to 48 in the second quarter, consistent with the continued sideways movement of the bank's leading indicator of economic activity. The outlook for the mining sector remains bleak, following a 0.7% year-on-year contraction in May. Although production showed positive month-to-month growth for the first time in 4 months, on a 3-month to 3-month basis, the sector contracted by 1.4%. There are indications that the manufacturing sector will make a positive contribution to growth in the second quarter, following the annualized 7.9% contraction in the first quarter. In May, the sector expanded by 2.2% on a year-on-year basis and by 0.9% on a 3-month to 3-month basis. This more positive trend is also indicated in the Kagiso PMI, which increased by 1.2 index points to 52.6 in July. The real value of building plans passed remains on a moderately upward trend despite a decline in May. The FNB Construction Confidence Index reflects some improvement, having increased by 4 points to 41 in the second quarter of 2013, although the Civil Construction Index declined somewhat over the same period. Underlying the sluggish economic growth outlook is the low growth in real gross fixed capital formation, which moderated from an annualized 4.3% in the fourth quarter of 2012 to 2.5% in the first quarter of 2013. Private sector fixed investment growth slowed from 3.8% to 2.8% over this period and reflected lower outlays in all sectors apart from agriculture, construction and finance. Work stoppages at Eskom's Medupi plant also impacted negatively on investment by state-owned enterprises in the quarter. Fixed investment expenditures is likely to remain affected by low business confidence and prolonged electricity supply constraints. Employment growth remains subdued, particularly in the private sector. In the year from March 2012 to March 2013, employment grew by 1% or 80,000 workers, of which 65,000 were in the public sector, although this number was inflated by temporary appointments relating to municipal by-elections in the first quarter of the year. Employment contracted in the mining and manufacturing sectors during this period. The official unemployment rate increased from 24.9% in the fourth quarter of 2012 to 25.2% in the first quarter of 2013. Of particular concern is the increase in the youth unemployment rate to 52.9% in the first quarter. Slower growth in real consumption expenditure by households is indicative of declining consumer confidence and the relative lack of excessive demand pressures in the economy. Household consumption expenditure growth moderated to 2.3% in the first quarter of 2013, driven mainly by more subdued demand for durable goods, particularly motor vehicles. Real retail sales, trade sales surprised on the upside in May with year-on-year growth of 6.2%. Nevertheless, retail trade sales increased by 0.5% in the 3 months ending May compared with the previous 3 months, suggesting a continuation of the moderate growth in sales. Consumption expenditure is expected to be constrained by high petrol and electricity costs, higher consumer debt levels, and declining growth in credit extension to households. Despite a moderation in the growth of household debt in the first quarter of 2013, the ratio of household debt to disposable income was unchanged at 75.4%, as growth in real disposable income also slowed. 12-month growth in total loans and advances extended to the private sector increased by 9.3% in May, but excluding mortgage advances, the increase was 16.8%. In the first 5 months of 2013, general loans, mainly unsecured lending, continued to account for the bulk of the increase in credit extension, but at a slower pace, particularly to households. 12-month growth in general loans to households declined from a recent peak of 35.4% in September 2012 to 24.4% in May 2013. The slowdown is more pronounced when measured over 3 months. In the 3 months to the end of May 2013, annualized growth was 11.3%, compared with rates of increases in excess of 30% during 2012. One of the upside risks to inflation remains wage and salary increases. In the first quarter of 2013, a stronger upward trend was observed, with growth in nominal remuneration per worker increasing from 6.6% in the fourth quarter of 2012 to 7.5%. With slower productivity growth, this implied an increase in unit labour cost growth from 5.2% to 6.7%. These increases are consistent with the overall average wage settlement rate in collective bargaining agreements published by Andrew Levy Employment Publications, which increased from 7.6% in 2012 to 7.9% in the first quarter of 2013. Other upside risks to the inflation outlook emanate from food prices, which have been accelerating over the past few months following a low of 4.6% in September 2012. Food price pressures are intensifying at the producer price level, with manufactured food product prices increasing by 6.9% in May. Although agricultural product inflation remained subdued at 2.6%, this was mainly due to the 13% decline in live animal prices, which offset the 10.4% increase in cereal and other crop prices. More favorably, global food prices have declined as a result of expectations of bumper crops in some of the main grain-producing countries. The FAO International Cereals Price Index decreased by 10.1% since September 2012. Global oil prices have broken out of their recent trading range of between $100 a barrel and $105 a barrel, mainly due to political developments in the Middle East. However, the relatively subdued global growth outlook, particularly in China, is likely to restrain these price increases. The current under-recovery of around 36 cents per litre on the domestic petrol price is mainly due to international price developments and indicates that a further petrol price increase can be expected in August. The MPC continues to face conflicting policy choices relating to rising inflation and slowing growth. Inflation is expected to resume its upward trajectory following the brief respite in May. However, despite the upward trend in core inflation, there are no strong signs of excess demand pressures, and the forecast for headline inflation suggests that the breach of the target may be short-lived. The main upside risk to the inflation outlook is the exchange rate, and much will depend on the strength of the path-through to inflation, which to date has been relatively muted. However, the risk remains that these pressures could be mounting, particularly if further currency weakness occurs and affects inflation expectations, which are currently anchored at the upper end of the target range. In addition, the outcome of the present round of wage bargaining will be critical in determining the extent of the wage pressures on the inflation outlook. The output gap has widened and is only anticipated to begin to narrow during 2015, when growth is expected to be more or less in line with potential. The downside risk to growth has already resulted in the bank being more tolerant of inflation at the upper end of the target range than would normally have been the case, an approach that is consistent with a flexible inflation targeting framework. While the upside risks to the inflation outlook reduce the scope for further accommodation, a tightening of monetary policy stance does not automatically follow. This will be highly dependent on how we see the inflation trajectory unfolding in this very uncertain environment. In other words, it has become even more data dependent. At this stage, a sustained breach of the inflation target is not our central forecast. However, we are concerned about the revised higher trajectory of core inflation and macroeconomic vulnerabilities that are increasingly evident. The MPC is mindful of these conflicting pressures in the challenging domestic and global environment, and will continue to monitor developments closely and act appropriately to achieve its mandate. The MPC has decided to keep the repurchase rate unchanged at 5% per annum. Thank you, and we'll now open for questions and comments. And obviously my colleagues will be ready to field the questions that you raise. Renee?
Good afternoon, Governor. It's Renee Volgra from Sunday Times. Governor, I want to ask you, in the last paragraph of your speech, the speech that you handed out to us, you mentioned the fact that the monetary policy stance depends on the inflation trajectory and also that it's very data dependent. Now, we've grown quite accustomed to the inflation data for the most recent month being available by the time the MPC meets. And in this case, it's not so because we're only seeing what the inflation figure for June was next week. How has that affected the way in which you thought about the inflation figures and also the inflation forecast?
It should not affect, because that is coincidental. It's not timed, and there's no way that each Monetary Policy Committee meeting will coincide with the release of data. We meet every 2 months, and that's a monthly figure. So sometimes it occurs and sometimes it doesn't. The question is that obviously we have our own models. We look at it. It's helpful if we've had the last number, but it's not critical, because the analysis must be forward-looking and look at the data in and of itself and not be influenced by the last number. The most recent number should be seen in the context of what is happening below that and what's driving it, and therefore it is something that is coincidental. We're not able to influence whether it comes out and at what time and coincides with the MPC. So you'll see during the year, sometimes it does coincide and sometimes it doesn't. Other questions? Yeah, Yolanda?
Governor, question from Rob Price. Why has the rand underperformed emerging market peers so poorly through 2013? And why have central banks from other emerging markets, which also have weak currencies, reacted to their weak currencies by tightening monetary policy, but the SARB has not? For example, Brazil, Turkey, and India. Thank you.
Well, I'm going to ask Daniel to deal with that for a start, and others who would like to add. But just to say that each country has country specifics. And the things that are driving the decisions in Brazil, don't forget that if you looked at their inflation rate, they've got different issues there. A lot of the issues around Turkey, Turkey has looked at a band. What you're seeing, and by the way, I don't think that we have been more or less, there's a group of emerging market countries that have been significantly impacted by the statements by the Fed about potential or possible tapering off, which, as we've seen, Ben Bernanke has taken a lot of time to address and try to clarify exactly what this means. But those countries are Mexico, Brazil, Turkey, South Africa, Korea, Poland, and you'll see that we've moved very similarly. Sometimes we are worse, sometimes we are better than them. So I wouldn't say that we have been very different from that grouping. We've all been impacted and have taken different responses to that. But perhaps Daniel, or you'd like to
just to add to that, what the Governor has just said, the sort of recent trading levels of the rand have been influenced by both international and domestic factors, and with obviously the most significant event that has influenced markets, not just currency markets, but bond markets, equity markets, being the most recent comments from the Fed indicating that they might start slowing the rate at which they are prepared to use their balance sheet to support growth. And in fact, in the most recent period, we have seen the rand very much being driven by these international factors. Clearly, there were domestic factors that have dominated at certain periods, but more recently, as the Governor has just indicated, we were moving very much in tandem with other emerging markets and other currencies that have been affected by these. But it is a combination of international and domestic factors that would have led to these trading ranges that we've seen.
I think I just want to add something to that question. One of the issues, and I think many of you who've come consistently to these MPC press conferences and have watched what we've been saying, our concern has been that this global crisis is now in its 6th year, and it has constantly mutated from one particular problem to another. None of them have been resolved, whether it is your systemic banking crisis, what's happening in Europe, is there interbank lending. All of those issues are still with us. Sovereign debt, debt GDP ratios, all of those things are there. And what you're seeing as measures are taken to address what is the next development, it has unintended consequences and a new problem arises. And what you're seeing is that while the Fed is taking a view to say we are looking at when it is appropriate to possibly stop or slow down the amount that we are purchasing. Don't forget they're purchasing $85 billion a month. And this is something that, they're saying they might have to we'll be looking at slowing down, very different from whether you're raising rates. One of the consequences has been an impact on the capital flows out of emerging markets and what has happened to their exchange rates. And that, in many ways, is the next mutation, in my view, around what is happening as a consequence of the crisis and measures that you need to take to address a particular issue, as the Fed is doing, has unintended consequences. And this is the nature of the crisis that we're in, with no end in sight. So at the moment, that mutation, in my view, is an impact on emerging markets. Now, don't forget, the emerging markets that we're talking about, China, India, Brazil, have been the counterweight to the growth story of the very difficult conditions in the Eurozone, which, as you know, is still in recession, as well as the difficulties which the US in growth terms seems to be coming out of. So a slowdown in emerging markets in terms of growth, as well as an impact on their currencies and capital flows, is the next form in which this crisis is impacting. So we need to see it in the context of what is happening. Yes?
Good afternoon, Governor. My name is Nzakisi from Business Day. So going back to what you're talking about, the next mutation and the impact that it has had on capital flows, is the bank concerned about what this will mean for inflows into the capital account, which have always been the reason why we've been able to finance our current account deficit?
You would like to deal with that one?
Well,
go for it.
I can pick it up. Certainly, I think, as we've indicated in the statement, with the changes that have been occurring, much as we have continued to see net inflows year to date, both into the bond market and the equity market, we have seen the rate slowing down again, as was just been indicated, not necessarily related to South Africa in itself, but as part of a development of emerging market bond inflows or slowing down, and there having been reversals in the wake of these comments from the Fed. And clearly that has put pressure somewhat, and as we've indicated in the statement, it is the financing of the current account deficit is certainly not as comfortable as it used to be, and that's something that we would need to monitor carefully going forward.
Other questions? Let me just see if there's anyone else. Renee? No? Renee?
Thank you, Governor. Governor, it's also something you mentioned in your speech, but I would just like to know if someone on the committee might be able to expand on the views the committee has on that. It is about the limited pass-through effect of the weaker currency on inflation. You mentioned the fact that the price pressure is not working its way through to the economy at the moment, but it might come later. But I'm interested in why. Why is that price pressure not going through to the economy to the effect that we would expect?
I think it's primarily due to the slower growth. But colleagues? Rashad?
Thank you very much. Well, as you know, calculations of pass-through are based on a long time series of what's going on in the economy through various times, through cycles, through recession and so on. And it's usually the case that when we say that output gaps are negative or the economy is in a kind of stagnant growth, the impact of the exchange rate is such that when there's no demand pressures in the economy, firms are reluctant to pass through those immediately to consumers. So in times of negative output gaps, the pass-through tends to be lower than in times when the economy is overheating. So really that's the case. So, our models depend on an exchange rate pass-through, but these are long-term pass-through coefficients. So when you have a recession like this, the pass-through tends to be much lower. We're not in a recession, but we're certainly in growth where, in fact, even the output gap is widening.
Any other questions? Yes,
Hi, Governor. TJ Stodham from The Times. At what rate does the economy have to grow for us to create enough jobs in this country? And I'm assuming it's not 2%.
No. Would you like to deal with that as well? But obviously, I mean, there's the ratio around it. Is how much comes in, how many new people into the market. But Rashad, would you like to follow up on that one as well?
Obviously, the big question here is what happens to labor participation if labor participation increases. So the historical experience, and this is not a calculation, is that if you remember that in the boom period when we were growing at 5%, the unemployment rate went down to about 22%. As we grow around 2-3%, you can see that we begin to kind of go above 5%. So I would say that a kind of a back of the envelope calculation is that basically if we start growing at 3.5-4% above that, then we start eating into bringing the unemployment rate down. In the range of 2 to 3%, it's very difficult to bring the unemployment rate down, particularly if you look at the growth of labor force and what happens in labor participation.
Any other questions? Yes?
This is Mary Blumenthal from Soccer 24. I just want to know your thoughts. You lowered the interest rate exactly a year ago, and after that, we should hope that the effects of that should be coming through only now because it takes such a long time. But still, growth is very low, and a lot of the reasons for it is beyond the control of South Africa. And do you, as the MPC, feel that you're backed into a corner with an instrument that you can't really have an effect if things are coming from the rest of the world?
I think there are two parts to that. How much is impacted by global events, and obviously it's significant. If you've got the Eurozone in recession, the Eurozone is one of our key manufactured export markets. You haven't necessarily got the stimulus from that. And then there's the whole question of confidence. If the global crisis continues, the question of confidence and what is happening generally is affected. So yes, there is an impact. If we looked at the reduction of the interest rates last time, there is an immediate impact, but not necessarily on growth. Your first pass-through, which is immediate, is those people who have bonds or mortgages which get affected, or that amount is reduced in terms of what they're paying. So it makes the servicing of debt costs slightly cheaper. But it is not necessarily that in South Africa, a lower interest rate, we've already got negative real interest rates, is going to be the stimulus to get growth going. It's a combination of things, and we've said that before. For South Africa, there are domestic issues, there are regional issues, and there are global issues. And there are things that we can do things about, and there are things that we can't. So let's deal with the things that we actually do have influence over and see how we can impact on that. And don't forget, we are functioning or we're located in a region and part of a region which is a growth story. Now, that may well be impacted by commodity prices going forward, but right now you've got very significant regional developments, the discoveries of gas. A lot of our neighbors are growing 5% and above, and South Africa is part and parcel of that story. And we need to integrate more into that and look at our trade opportunities and our integration into the growth story of the continent more. But it's not simply an interest rate story. I think that growth, and also we should not, while we need to recognize and address those things that we can, that are impacting on us from the global economy, we also need to address the things that that are challenging in the domestic economy. And that's why government, I think, has taken an approach on an infrastructure build program to address your economic inefficiencies, to look at enhanced effectiveness. As we say in the statement, if we don't get enhanced electricity supply, it's very hard to grow above the levels of 3%. You do not have enough electricity to do that, or energy to do that. So there are domestic issues as well that we need to address. Yes, sir.
Franz Wild from Bloomberg. Governor, Two questions. The first you can probably guess.
Unanimous or otherwise?
Exactly. And were there any, was a cut or a hike discussed and supported by anyone? And secondly, obviously there's risks to both your inflation and your growth outlooks. Are those risks balanced, or is is one worse than the other?
On the unanimous, yes, it was unanimous. And as I've said before, although you may come to a unanimous decision about what you think, it is nonetheless vigorously discussed and debated as to the reasonings for that and the motivation and what you see, so that we may come to the same conclusion but with slightly different angles to that. And no, nobody discussed any alternative to hold the position at this point in time. In terms of evenly balanced, I think that what we're trying to say here today is to say that we are challenged by both, because you need a different policy response for both. If you're looking at the growth story and what policy response, it requires one type of response, and if you're looking at the inflation story, it requires a different policy response. And at this moment, what we've indicated here is our concerns to the inflation outlook, especially given the revision upwards of core inflation. And therefore, at this, we are saying that that is a concern. Perhaps, if one had to look at it, it's not quite evenly balanced, but we're challenged by both. But again, our mandate is about inflation. So we are highlighting that perhaps a little bit more this time, but challenged by both. Other questions? Any additions that anyone would like to make? Anyone else? Yes, sir.
Martin Whitney from FM Business Day. You mentioned the greater transparency by central banks that's been noted in the last few months. Are you satisfied with the guidance that the Reserve Bank gives at the moment, or do you still feel there's room for improvement?
I would never say we're satisfied, especially if you get confused by what we say. So, Martin, I hope that we are clear enough in what we're saying. Yes, there has been much greater transparency, but again, and I think there was an editorial in one of the newspapers that looked at the pros and cons of what different central banks are doing. And we remain of the view that we give you a very comprehensive report about what we think and why we've come to the conclusion that we have, rather than minutes of the meeting. And we've explained before that our concern about minutes is that we do, our mandate is a collective mandate. We are all members of we are all in the bank. We're not outsiders. There are no outsiders in our MPC. And that is something that we think is an important question, because outsiders you have a whole different relationship when you do have external parties. The structure of the Fed is a historic one. The relationships and roles in, say, the UK or the ECB, the Bank of England, is different. And we feel that we give you as much information, perhaps even better, than you would get in terms of a minute. But it enables a discussion to take place without anyone being concerned about, oh, I took this view, how did you hold that, why did you hold that view, and so on and so forth. So I think it allows people to give their views freely, frankly, and fully in a safe environment for that expression, and allow you to listen to each other with the ability to actually pay attention and not come with a fixed position. Because if I'm going to be said, this is what my position, then why do I change? How do I change? So I think it's very important that we have the ability to listen and hear each other properly. And I do think that we are very open. Don't forget, minutes, I have absolutely no doubt, if you prepare minutes, many of you sit in meetings where you prepare minutes. Are the minutes an exact reflection of what everybody said? Or are they best estimates and dealing with outcomes? Minutes vary. I think this is and if there's, certainly we're always open to ways of improving the communication. I mean, part of the communication effort is to have all of us available here. Part of it is an ongoing question around your monetary policy forums, the question of When the Monetary Policy Review is put out, members of the MPC and those who support the MPC travel around the country and answer questions. I think it's being open to the media and the public on these issues. Frans?
Governor, just to follow up to my previous question, you said you were highlighting the risks to the CPI forecast more than the risks to the GDP forecast. Do you therefore believe that the risks are greater, or is it just something that you're more focused on?
I think what we are saying here, and we've emphasized it very particularly around core, is that core has gone above 5% consistently. And that is some of the underlying, which may well indicate that there are other underlying pressures in the system. So we are highlighting it to that degree, to point that out and saying that obviously if you looked at it, it's not, again, either or. We take growth into account. We do need to, and we take all these factors, as we've mentioned, into account. But we are drawing attention to the question that inflation, in terms of core inflation, which we obviously watch quite carefully, has also risen and been revised upward, as well as the question that your peak of outside the target, which is for this quarter, the third quarter in 2013, is now expected to be back up at 6.3%. So it is a concern.
Governor,
Yes,
TJ Stodum again. The spectre of unsecured lending. I see you say it's been that we've seen a tapering off in those loans. Has it been overblown, or were we expecting that it was going to flatten eventually? And is it because of good policy choices by government, or banks finally seeing that they shouldn't loan as much, or is it just all coincidental?
I'm never sure that things just happen coincidentally. Who would like to respond to that? Anyone? The question for me is on unsecured lending. I think the numbers show a decline. And as we've said before, is that, from the bank supervision role, it has engaged very actively with boards and with banks on this to look at the question. I think banks and lenders themselves who are in the regulated sector, and I would draw that distinction, lenders who are in the regulated sector are looking much more carefully, because it's part of the question of looking at what is happening to impairments, what is happening to bad debt. And so you've seen statements from the lenders themselves saying they're being more cautious. So I think it's a combination of factors. I do think there's a question that relates to that lending which takes place outside of the regulated entities. And I think that also needs to be focused on. Now, I think that part of it is really ensuring that you have an informed public. What does compound interest mean? What does a loan at this rate of interest actually mean for you? And how much are you paying? And, to me, the question is, the more you can have an informed consumer who understands and develops a track record, and your customer, the better off that person can be, because you can actually manage that relationship better, far more than being in the unregulated loan environment, because I think that is very difficult for people. And yes, that also adds huge pressures. So if you don't get a loan in the regulated and you get it in the unregulated market, you can find yourself paying exorbitantly. And so there is a question here, there's no doubt, there is a question about access to finance. And part of the policy is a policy of inclusion. I mean, financial inclusion has been a big question for South Africa over many years, to see how do we get the unbanked into the system. And there's been many vehicles to do that, including social grant payments into a banking system, so that you're trying to formalize and at the most cost-effective way, but to protect the individual and ensure that they have access to finance and financial inclusion in a way that was not there before. I mean, if you took just your two banks, African Bank and Capitec, between them, it's close to 8 million clients. That's a huge number of South Africans who have access to finance. Whatever those rates are, they're within the regulated environment. Are there rooms for improvement? Always. But the concern I would have is not just what happens in the regulated, but what is happening in the unregulated. Anyone else? Yes, on the phone.
Governor, a question from Peter Montalto.
Hi, Peter. We were waiting for you.
On
Most
inflation,
welcome.
on inflation pass-through, are you looking at any survey evidence or direct feedback from retailers and importers, or are you just looking at model-based estimates? What markers are there to watch? Thank you.
Rashad?
We have an army of people in the research department as well as in financial stability and bank regulation who do research, and this is a combination of people who do modeling, people who collect data, and people who speak to firms. So it's a combination of things, and I think that many other indicators are quite important in coming to this conclusion. There's a lot of judgment, sure, in the model, both the empirical estimates as well as kind of theory will tell you that this is what happens. But we constantly try to speak to firms. We'd like to do it more widespread than we do, but firms will tell you that this is, our sales are low, it's very hard to sell goods, so, firms, so we rely on a variety of approaches to make some of these observations.
Anyone else? Anything that anyone would like to say, add, subtract? Anyone? If not, thank you all very much. Thank you for joining us on this very auspicious day. Okay, hang on. Oh, it's Kali's birthday as well, so you're part of a very auspicious day, Kali. I hope you did your 67s. Tonight. But everybody, thank you all very much for being with us today and for joining us on as part of this Monetary Policy Committee press conference. Thank you, colleagues. Thank you.